We will talk today about a report Liquidity has written together with several other co-authors. Probably you can specify that. We're very happy to have Phil Dudley back on campus. He is a scholar for GSAPS, the Criswell Center, and he taught many years, I think, a crisis class here at Princeton, and probably some of your students will still remember his teaching. But he was also, before that, he was president of the New York Fed and was leading the New York Fed during the 2008 crisis, 2009 crisis, and it's a lot of experience also in policy making more generally. And before that, he was a chief economist at the Goldman Sachs, and before many other things. I think also what he does at the moment is also heading the Bretton Woods committee, which writes important reports and shapes policy making as we speak. So we're very happy to have him here with us today. And the idea is that Bill Dudley will first explain a little bit what the report is about and what his proposal is, and then we will have a fireside chat back and forth, and we will also involve you subsequently with Q&A. So don't be shy. Think about your questions already now, and then you can ask questions later on.
So happy to be here. Happy to be here with all of you. You know, it's funny, when I did my teaching here, I got my evaluations, and they were pretty good. But I got one evaluation from one student who said, "I liked your course, but it wasn't as good as Alec Blender's course." And I sort of said to myself, well, I've been teaching for like 2 years. Alan's been teaching for like 4 years, so I can take that. And Alan's a really great teacher, so I felt like, you know, the standard of comparison was a little difficult. So let me first off just start out with what's the Group of 30, and then we'll talk about the report, and then we'll talk about the conclusions of the report. So the Group of 30 is this very strange grouping of basically former central bankers, former finance ministers, a few academics, Neil Ferguson, historian, and it's sort of self-selected. So it's 30 people plus a lot of senior emeriti above that. So the total count is probably more like 50 or 60, but there's 30 people that are considered, active. And what the Group of 30 does is they do basically two things. Number one, they meet among themselves and they talk about what's going on and how they think about things. And number two, maybe two times a year, they publish a substantial paper on some topic. And those papers can vary all over the place depending on what people think is important. So a few years ago, there was a series of papers on bank culture, which is very interesting to me because as the head of the New York Fed, we spent a lot of time focusing on culture as one of the things that need to be fixed post the great financial crisis. So what happened here was Tim Geithner had an idea that we should write about what happened in the U.S. banking crisis in March of 2023. And he said, well, I'm conflicted because I'm working at Warburg Pincus. Who can I get to run this project? And he sort of came to me. And then we recruited three really good scholars, Stein Clausen, who just retired from the BIS, Patricia Moser, who used to be at the New York Fed, is now a professor up at Columbia, and Darryl Duffy, who's a professor at Stanford. So that was the core team. And we got together and we started working on this project, and Stein had the pen, which is always nice not to have to hold the pen. As Marcus knows, he did a Group of 30 project where he held the pen. That's a very difficult assignment. And we basically started talking about what were the causes of what happened in March of 23 and what should we do about it. And we actually made a lot more progress than I think we thought we were going to get because we all agreed with each other. And so we sort of spurred each other on. So, what do you think about saying this? Okay, how about this? And so the report is actually, for a Group of 30 report, it's actually fairly provocative and fairly, pushing the official sector to do more in certain respects. So that's the report. And you can get it online at the Group of 30. It's also in the note that Dana sent around. So what went wrong? A lot of things went wrong to give you the panic that we got in March of 2023. Bad supervision, bad regulation, bad accounting, bad risk management, the consequences of quantitative easing. You might wonder, why did that play in? Well, the Fed, by buying all these securities, flooded the banking system with deposits. So banks got a lot of deposits and they had to make a choice. Well, what do I do with these large deposit inflows I have? A lot of banks made the intelligent decision of investing those deposits short term because they were demand deposits typically. But a few banks, like Silicon Valley Bank, like First Republic Bank, decided to take those deposits and invest them in long-term fixed-rate assets, which worked out okay until the Federal Reserve actually started raising rates. And so as the Federal Reserve is raising rates, two things are happening. The cost of their liabilities are going up. They have to pay more on deposits. And number two, bond yields are going up. And so the value of those assets that they bought is going down, falling significantly below par value. So the net consequence of what was happening in terms of their decisions to make these large interest rate bets was to have a squeeze on their operating profits, their net interest margin, and also a squeeze on their sort of mark-to-market capital. Now, this was this is not all flow through to their book value of capital because the accounting principles basically said, if you say you're going to hold these securities to maturity, you don't have to flow those losses through your capital statement. But investors could see the losses on the securities, and the investors could see the squeeze in the net interest margin, and so they knew that these banks were at risk. Lots of failures here. The Fed was really slow to push Silicon Valley Bank to do something about their interest rate mismatch. The Fed was really slow to get the Silicon Valley Bank to have a chief risk officer. They literally did not have a chief risk officer for 7 months. There was a failure that the Fed made in terms of prudential regulation. During the first Trump term, a law was passed that basically lowered the rate, the asset size at which you were subject to tougher prudential supervisory standards. It gave the Fed the discretion to raise the standard back up for banks. The Fed declined to do that. So the Fed could have subject these banks like Silicon Valley Bank to tougher prudential standards, but they decided not to do that. And so that was also a consequence. So lots of things going on. When I look at what happened, it's really a confluence of two things. One, really bad interest rate risk management on the part of the banks. And number two, the reliance on very short-term concentrated retail deposits. I mean, for example, at Silicon Valley Bank, I think Circle, the crypto company, had something like $3 or $4 billion of deposits at Silicon Valley Bank. So probably not good treasury risk management practices at Circle. And so what happened was you had the interest rate squeeze, you had the earnings squeeze, and then once that went on beyond a certain point where people started to worry about the viability of the companies, they saw these very large mark-to-market losses in their portfolios, the depositors got nervous. And then what happened was they ran much faster than depositors had ever run before. I mean, Silicon Valley Bank basically went from thinking about how they were going to raise capital to plug their hole in their portfolio to failing in 3 days. Now, they also executed really poorly. They sold a whole bunch of securities and took a big loss on a Tuesday, and then they said on Wednesday we're going to raise the capital, rather than doing it the other way around. You'd think you'd raise the capital and then sell the securities. But so the run started basically sort of Wednesday into Thursday and got very, very intense. And once Silicon Valley Bank was infected, of course, then everyone's looking around to any bank that looks remotely like Silicon Valley Bank. And the runs went on to a number of other institutions. The ones that failed were pretty idiosyncratic in terms of their setup. Like First Republic Bank eventually failed, Signature Bank failed, a crypto bank, Silvergate, failed. But the contagion went quite a bit broader than that. Any regional bank that had a large commercial real estate exposure came under quite a bit of scrutiny as well. So what were the lessons here? So the lessons are lots of things to fix, and the paper talks about all of them: supervision, regulation, accounting. But the novel, we like to think the novel contribution that we are making is really in the whole issue of liquidity and lender of last resort. So we witnessed that deposit outflows are far faster than expected, far greater than what's assumed in the liquidity regulations that the regulators apply to banks.
So, okay, the logical thing to do is then, okay, let's recalibrate the liquidity regulations and require banks a whole lot more liquidity. The problem with doing that is you're going to make banks a lot less profitable. And if you make banks a lot less profitable, you're just going to push a lot of activity out of the banking system into the non-bank financial sector. So do you really want to do that? So how can you recalibrate the liquidity requirements without making this a huge additional burden on banks? And so our view is, all right, why don't we force banks to pledge collateral to the discount window and then allow banks to get some credit for that pledged collateral in terms of satisfying their liquidity requirements? So that's number one. Number two, we felt that if we had a requirement that banks had to pledge collateral to the discount window equal to all their runnable liabilities, that would reassure uninsured depositors that I don't actually have to run in the first place, because the bank can turn their collateral at the Fed into cash at a moment's notice. So, I mean, I think the novel part of the paper is the way you prevent runs is you basically reassure that there's no reason to run in the first place. The third aspect of this that I think doesn't get quite enough attention is that if you had this requirement in place, Silicon Valley could not have done what they did, because they would not have had enough collateral to pledge to the Fed to cover all their runnable liabilities. Silicon Valley Bank had about 95%, I think, of their deposits were uninsured. And the losses on their securities portfolio was quite large. So they would have run out of pledgeable collateral to the Fed long before they could have had that balance sheet. So you would also have limited sort of the bad behavior of Silicon Valley Bank. So to do this, a couple of things have to happen. Number one, the Fed has to reinvigorate the discount window so it actually works efficiently, so you can move your collateral in and out of the discount window very quickly. Number two, they have to be more systematic about how the discount window operates. So every reserve bank operates the discount window the same way. Going into this crisis, every different reserve bank had a little bit of discretion on how they operated their discount window. They had this quote called "secured to my satisfaction." And that allowed a lot of wiggle room among the different reserve banks. You don't want to have that. You want to have a very consistent regime. And the third thing is then require the banks to pledge the collateral equal to their runnable liabilities. And we think if you did all this, you'd have a truly efficient lender of last resort function in the U.S. that was actually reassuring to uninsured depositors. Now, there's other ways you could go. You could raise deposit insurance limits and just say we're just going to cover a lot more of the depositors, and that way there'll be less run risk. But if you do that, you're essentially providing a additional subsidy to banks to act badly. And we saw during the savings and loan crisis back in the 1980s that when you actually insure all the deposits, banks tend to make big bets. They tend to go for broke. So there really is a moral hazard problem with raising deposit insurance. So we think this is a better approach. We've been pretty gratified by the reaction. Michael Barr did not, sort of throw us out of his office. Michael Barr is the vice chair of supervision at the Fed, and he's actually proposed reinvigorating the discount window and requiring the banks to pledge a significant amount of their unsecured liabilities at the discount. Not 100%. I think it's something he's talking about, something like 40%. But we're on the right trajectory. What I'd like to see the Fed do is run a quantitative impact study to sort of see if you had this requirement in place, how binding would it be for banks? And then once you see how binding it is for banks, you can decide what adjustments you might need to make. But the Fed hasn't done that at this point. So there's still work for them to do potentially. So that's the summary.
So thanks a lot. Thanks a lot, Bill, for outlining the main proposal. So I would like to come back to... You're too loud. Can you adjust it? So I would like to come back to the discount window more generally, because one big issue is the stigma in the discount window. So the stigma essentially meaning that if a bank is in difficulties and has to go to the Fed and say, can I borrow against this collateral? It's a signal to the rest of the market participants that, oh, there's something wrong, and then people run and triggers are run on the thing. Do you think your preparatory arrangement that, you go to the discount window even before you need funds and put the collateral already there?
All you're doing is pledging the collateral. You're not actually drawing from the discount window. The draw from the discount window only happens if the run actually manifests itself, right? So
it won't help on the stigma dimension then? Or?
Well, there'll still be stigma going to the window because you're going to the window because you don't have any other source of funding. But the point here is you're reassuring the depositors that they don't have to run in the first place. So if they don't have to run in the first place, the bank's not going to be short of funding. If the bank's not short of funding, it doesn't actually have to go to the window. But the Fed's always going to have a stigma problem with the discount window because the cost of discount window borrowing is above the cost of other borrowings in the market. It's above the federal funds rate. It's above the repo rate. So if you're borrowing at a rate that's higher than what other people are borrowing at, it is a sign of distress. One of the problems of the crisis too is as people were forced to go to the window and to the Federal Home Loan Banks for advances, as the deposits ran off, it was also putting an increased squeeze on their net interest earnings, right? So their earnings are going down as this is happening because they're replacing low-cost deposits that are running out the door with higher-cost discount window loans and Federal Home Loan advances. So this is the reason why the run can sort of keep going. And a bank that was solvent before the run started could actually be insolvent after the run's over because its cost of funding has gone up significantly. So in the US, you have the system that you can actually also go to the Federal Home Loan Bank to get some funding. So discount window is essentially just a really lost land of the Federal Home Loan Bank system in the US is a really crazy system where the Federal Home Loan Banks basically go out and issue money in the capital markets and then use that money to lend to their member banks. And they lend to their member banks against, like home mortgage collateral, things of that sort. And I don't think anyone really anticipated that this was going to be such a big business. And the home loan bank borrowing is not stigmatized because it's sort of at this competitive market rate. And the member banks actually have a little bit of equity in the Federal Home Loan Banks. And so they actually get a dividend from the Federal Home Loan Banks that actually reduce the cost of borrowing. Now, it's interesting. If our proposal was actually put in place, it would, by necessity, reduce the role of the Federal Home Banks as lender of next to last resort because the collateral would be pledged to the Fed. Now, presumably what would happen is the Federal Home Loan Banks would go to the Fed and say, well, we'd like to work with you to be able to move the collateral from us to you very easily so we can stay in business as a next to last resort lender. So I think this gives the Fed a little bit of leverage to have a serious conversation with the Federal Home Bank system about their role in this lender of last resort function. So you wouldn't shut it down? I probably would, but politically it might be difficult to do so. So I'm trying to be realistic about the fact. I mean, you have you have 11, I think, Federal Home Loan Banks. One got merged out of existence because they basically failed, operating all around the country. So you can sort of see the political support for this, and the banks like it, in part because it's not stigmatized. It's independent of their regulator, so I think they like it. So I think it'd be probably hard politically to shut it down, but it'd certainly be great to force a lot greater cooperation between the Federal Home Loan Banks and the Federal Reserve, and make it seamless to move the collateral back and forth. That's what you'd like to see. So I was wondering whether you can step back a little bit, because the FDIC also came out with a report earlier, or at the same time, or even afterwards, saying, okay, we can also do FDIC insurance, blanket insurance. And then on the other hand, in the UK, you had an FDIC insurance or deposit insurance scheme where it's only 90% or 80% are guaranteed. Can you just contrast different ways to arrange it? So one is to have a limited FDIC insurance, and then you have your own the proposal that you pledge the collateral in advance to the discount window. So that's your proposal. But how does it contrast to the other proposals? So the theory in the United States is that we need to have deposit insurance for uninformed retail depositors who just don't know what's going on in the bank. And then above that limit, we're basically going to force people to make decisions about the viability of the bank. and hopefully they'll make good decisions. This is the sort of this notion of market discipline. I think that in reality, market discipline doesn't really work that well in practice. There's basically no discipline, and then there's like total discipline. It goes from 0 to 1, so it doesn't work very well. So that's the argument for basically raising deposit insurance limits, because the market discipline story doesn't work very well, and so that's an alternative approach. But if you do that thing, you're also increasing the cross subsidization between banks. Banks that behave well versus banks that behave poorly, because when a bank fails, the losses to the system will be greater. Remember, the banks that survive pay the cost of deposit insurance losses for the banks that fail. And in Silicon Valley Bank's case, at one point, I don't know what the current estimate is, but the original estimate was that Silicon Valley Bank was going to cost the FDIC $20 billion, which is an extraordinary amount of money when you realize that the size of Silicon Valley Bank was $200 billion. So not only did they run through their capital, they ran through an additional $20 billion. The UK approach of insuring only a portion, like 90% of your deposit, that to me seems really risky, because so I'm only risking 10% of my deposits that the bank is going to fail. Still have an incentive to run, I think. Still have an incentive to run. When we saw with Northern Rock, the UK system didn't really work very well. So they did have a deposit insurance system. It didn't really work very well. I think the FDIC system has been built up over many years to be very credible with retail depositors. Typically what happens is the bank closes on a Friday and reopens as a new bank on a Monday, and the depositors don't even really notice that the bank has changed, except that the sign out front gets changed over the weekend. And so I think the credibility of the FDIC means that the insured deposits are pretty bulletproof. And we sort of tested that proposition, because there's been a lot of zombie banks around the U.S. over many years. Sometimes it takes the FDIC quite a few months and years to get around to closing a bank. There was a bank in Puerto Rico when I was president of the New York Fed. I kept asking, when are they going to close this bank down? And the answer was, well, we know that this bank is going to fail. The FDIC just hasn't gotten around to it yet. That bank was relying on insured deposits, brokered deposits, and so he could stay in business as long as the FDIC allowed it. So the U.S. regime is pretty bulletproof from a deposit insurance perspective.
So another big component of your project was essentially the integration of different policy aspects. Have one integrated, no silo policy-making approach, and no separation principle in a sense. And one thing you mentioned, if the liquidity thing works well, we probably need less capital. So where do you see the interaction between the capital requirements and the liquidity requirements? Would you also argue, if you have this in place, we don't need LCR and other liquidity requirements so much? How does it interact with other?
So let's take the first one, the separation principle. So the separation principle is the idea that we can do bank supervision and regulation over here, financial stability over here, and we can do monetary policy over here. And neither the two can be completely separate. They don't need to talk to each other. They don't need to know what each other is doing. And I think that's actually a mistake, because if you look at what happened for the March 23 banking crisis, part of it was about QE. The Fed, by doing massive QE, flooded the banking system with deposits. Now, some of the banks made the mistake of taking those deposits and buying long-term assets, but the Fed essentially tempted them to do that. And the Fed, by doing massive QE and buying long-term securities, also depressed the yield on long-term securities. And so they were setting the stage for bigger market losses on those long-term securities when the economy strengthened and the Fed tightened and long-term interest rates moved up. So I think the monetary policy people need to talk more to the supervision and regulation people. Another good example of this is the leverage ratio. So for the banks, they have a leverage ratio. It's one of the capital requirements. And when the Fed does quantitative easing, they increase the aggregate size of the bank's balance sheet. That actually makes the leverage ratio more binding. So people like me have been arguing for years that you should exempt reserves from the leverage ratio, because here's monetary policy trying to be more expansive, and you're actually making this leverage ratio more binding. That doesn't make sense. So these two things need to be brought together.
Can you explain briefly how QE expands the bank's balance sheet?
QE is very simple. When the Fed buys a security, that person who had the security now has cash. If they decide to buy another security, that person who has that security now has cash, but the cash eventually makes its way into the banking system's balance sheet. This is why monetary growth is really rapid when you're doing quantitative easing. So quantitative easing expands the aggregate banking balance sheet.
So if the Fed were to buy, let's say, long-term treasuries from the private banking sector, then it's not a problem. It's just if it buys it from private entities.
Well, I mean,
then it ends up as deposits in the private banking system.
Yeah. And a lot of what the Fed's buying is from the non-bank sector. So the Fed is basically creating the deposit abundance, and that's why the monetary policy people need to talk to the supervision and reg people. And it just doesn't happen enough. You've seen this in Powell in his press conference. He's asked about a supervisory matter. He'll say, well, that's Michael Barr's domain. He literally won't really talk about it. And no, the Fed chairman owns financial stability writ large, not the vice chair of supervision. And so the chair of the Fed he's the person where everything needs to get sort of integrated.
But the leverage ratio is a particular US phenomenon, no? It's not part of
the supplemental leverage ratio is a US phenomenon, yeah.
And why is it still?
It's sort of this belt and suspenders approach. Like, okay, we have the Basel risk-based capital standards, but banks are going to play games with the risk-based capital standards, and maybe they're going to get away with doing things that aren't completely appropriate. So we're going to put this other requirement in place to sort of limit how far they can go in terms of overall aggregate leverage. It's probably. My own personal view would be, why don't we just get the risk-based capital standards squared away, and then you don't need the leverage ratio requirement. I think that'd probably be a better approach, because you're basically discouraging banks from holding low-risk assets when you have a leverage ratio. It's like, why do you really want to do that?
So can you perhaps elaborate a little bit, how does your proposals then interact with other requirements, capital requirements, and also LCR, other liquidity requirements? Perhaps explain all the concepts.
So capital and liquidity, right now the requirements are sort of completely separate. There's a capital requirement and there's a liquidity requirement. And the liquidity requirements in the U.S. really sort of consist of two types. There's liquidity coverage ratio requirement, which is basically a bank needs to have high quality liquid assets sufficient to cover 30 days of outflow. And that's what needs to be recalibrated, because, boy, you need a lot more assets to meet 30 days of outflow now than you thought you needed before this event happened. There's a longer term net stable funding ratio requirement that looks at liabilities and assets over a year time horizon. Much more complicated. I couldn't even explain it to you if I wanted to, but that's also a liquidity requirement. And then
can we get rid of all of these things once we have your proposal followed?
No, I still think you want the banks to have some self-insurance of their liquidity needs. So I don't think you want the banks to have to go to the disco window at any perturbation to their economic. So the way I sort of imagine it, business as usual, the banks have enough liquidity to handle their business as usual requirements. Then you're hit with a shock, and the discount window is available. And because people know it's available, then that shock doesn't sort of permeate across the system. The real problem with these kind of crises is when the first person goes, the stress on everybody else increases exponentially. So why did Credit Suisse fail right after this weekend? Credit Suisse is a very weak bank, but so this shock in the U.S. caused people to re-examine their assumptions about Credit Suisse. And so it sort of was a triggering event that caused the outflows from Credit Suisse. I think you need a lot of complex modeling to know exactly what the trade-off between capital and liquidity is. But there should be there should be some linkage, because more liquidity reduces the risk of fire sale of assets. So that reduces the risk that you're taking losses that deplete your capital. And so presumably if you have more liquidity, you don't need to, there's less risk of fire sale of assets, so there's less risk to your capital. So that's one element where you can see there's an explicit trade-off.
So we have just seen from Thomas Eisenbach that the announcement effects are very, very powerful. So when the FDIC announced at noon on Friday, this will happen, the run was actually made worse by that. And also the blanket guarantee made things worse. Do you have any proposal in that dimension to soften the announcement effects, essentially?
I don't think you can do much about the announcement effects, frankly, because we were talking about it at the seminar, and my sense is that they had to announce that it failed because they actually had run out of cash to pay off their depositors. And so they can't very well pretend it's open when it actually can't actually do business, right? So I think they had no choice but to say that it failed. The more tricky announcement problem they have is with what's called the systemic risk exception. So the systemic risk exception is when a bank fails, you can basically say, okay, all the uninsured deposits and the subordinated debt holders take a haircut to basically make the FDIC whole. Or you could say, boy, if we do that, that's going to be so scary to the rest of the world. We're going to have a systemic risk exception and say that we're actually going to cover all the liabilities. So in the case of Signature and Silicon Valley Bank, the FDIC evoked the systemic risk exception. The problem is the systemic risk exception can only be evoked after a bank has failed. And it only can be evoked on a case-by-case basis. So even if you've said that I've evoked the systemic risk exception for Silicon Valley Bank, you don't know if a subsequent bank fails that the FDIC will necessarily evoke the systemic risk exception for that. So if you go back and read the press clippings during that period, you'll see Powell and Yellen dancing around the issue about would we backstop all the banks, and they keep pointing to the systemic risk exception that they did for these two banks, but they couldn't actually come out and say, yes, we'll backstop all the banks, because by law, they weren't actually allowed to do that. So, one thing we could think about doing is having like a timeout. Like, okay, if there's a systemic crisis, that you sort of have a timeout and all the assets are protected for some period of time before we so we can figure this thing out. That's sort of what happened during the Great Financial Crisis, where the FDIC and others backstopped a broad set of bank liabilities, and that was essentially, expanding the deposit guarantee safety net significantly. But the systemic risk exception just doesn't do the job.
So let me go a little bit to a broader topic beyond what happened in the spring 2023. And, also in the light of the recent elections, I can see that, new digital forms of money will be more prominent with the new administration coming up. And we might have many more stablecoins. And you might view a stablecoin almost as a little bank or a narrow bank in a sense. Does it have, you propose any implications for stablecoins arrangements as well? And let's suppose the stablecoins are not 100% backed. It's essentially also subject to runs, and should the FDIC cover it, or will there be some?
Well, let's start at that observation. I think stablecoins need to be 100% backed, and they need to be 100% backed with Federal Reserve, central bank money, and or very short-term Treasury securities. I think they need to be completely bulletproof. Because they're basically the device that people use to go from a sovereign currency into a stablecoin onto a crypto asset. And so this thing that's the stable store of value in the stablecoin, that's what the stable's about, needs to be actually stable, in fact. So I think it's really, the problem in the US is we actually haven't come forward with any definitive regulation. And the leading stablecoin issuer is Ethereum, Tether, and it's not really regulated. They basically promise that their stablecoins are fully backed, but the audits are sort of infrequent and they're sort of voluntary. And that's not a good system to be in place. So I think legislation on stablecoins, is really important in the U.S. Basically saying, here's what a stablecoin is. Is it a security? Is it a quasi-currency? You need to define that, because you have to define who has the purview. Is it the SEC has the purview, or do the bank regulators have the purview? Then you have to be very clear on the backing, and then you have to make a decision. Do they have access to the Federal Reserve a master account? Can they actually hold their liabilities as a Federal Reserve reserves balances at the Fed?
But if they have access to the Fed's balance sheets, do they also have then the possibility to pledge other collateral besides?
No. This would just be that they would basically be able to invest their proceeds in central bank reserves. So they would have a cash account at the Fed, and that cash account at the Fed would be basically backstopping the stable coins. And then the central bank would have to make a decision. Do we pay them interest on the reserves like we pay the interest for banks? So there's a lot of decisions that have to be made, but it's a lot better than the current system, which is very much a Wild West system, where people are going to get hurt. I mean, we saw the algorithmic stablecoins that blew up. What was it, Luna? And what was the other one? The pair.
I forgot.
I think Terra and Luna. I think were the pair. It was supposed to work, and it didn't work. So I think, and I think the other reason why you want to do this for stablecoins is not just because stablecoins are this, interesting way of accessing the crypto world. Stablecoins could ultimately become very, very important as we start to tokenize financial assets, and basically take the claim, the asset, and the ownership and all the things into a token that sits on a unified ledger, potentially a distributed ledger. It doesn't have to be distributed. And it could be a very different way of trading and owning financial assets. And stablecoins are the sort of pathway into and out of that world. And a lot of people are doing, sort of pilot projects on tokenized assets. Stablecoins are a feature of how you get into out of those assets. So I think we need to do some work on it. And I think the Trump administration is going to be more forward-leaning in this dimension. And now, am I a fan of having a sovereign Bitcoin fund? I think it's absolutely insane. Why are you're buying this incredibly speculative asset and you're investing dollars that you've borrowed in the financial markets that you're paying interest on? So the U.S. Treasury would be borrowing money at 4 or 5% and investing in Bitcoins that have no yield. They're just a speculative asset. I mean, it's crazy. So hopefully they won't do that.
But coming back to stablecoins, so you need a law or the SEC?
Yeah, you need. But you either. I mean, look, I think you could do it by. You might be able to do it by regulation, but it'd be probably better if Congress sort of said, "Here's what we want," and instructed the regulators to go out and do it, because that would also the legislature could also manage the issue of whose responsibility it is. If there's no legislation, there's always going to be this sort of fight between CFTC, Federal Reserve, SEC, like who's actually, over in charge of this. And I think if you got legislation, you could sort of define who's responsible. And that's another problem of the U.S. regime. We have way too many regulators. I've been doing a lot of work on cross-border payments recently, and in the U.S., we actually have. If you're a money transmitter in the U.S., you're subject to 50 state regulators. There's no federal regulator for somebody who wants to execute cross-border payments from the United States to the rest of the world. It's all regulated by individual states. That's crazy.
But you predict that the new administration would ask for stablecoins 100% backing.
I don't know what they'll ask for. I mean, it depends on who the people are in the seats and how well the crypto community lobbies those people. I mean, if I'm a stablecoin provider, I want to have as much flexibility as possible, subject to I want to stay in business. Now, if you talk to the people that are sort of the more responsible people in the U.S. space in the crypto markets, Coinbase, Circle, Ripple, I think their view is that we want to have really good, solid backing for stablecoins, because that will actually give them a better foothold to compete with the people that are much more poorly regulated. Tether is just sort of everywhere. It's just sort of in the ether, hence the name. And that should be pretty scary from the regulator's perspective. So the best thing would be to create a really good stablecoin that people thought was better, and then people would go to the good money rather than the bad money, and that'd be a better outcome.
So going back to the discount window to some extent, if one could predict that the fintech world is actually, or the shadow banking system gains more and more prominence going forward, would you also change the access to the discount window? If you do this preparatory measurement, would you say, more institutions can participate in the discount window, or you would be very reluctant to go there?
I think there's sort of a bank charter has there's sort of gives and takes, right? Bank charter, I have to hold capital. I have to be subject to bank supervision. I have stress testing. In exchange for that, I get some things. I get deposit insurance. I get access to lender of last resort. And so you sort of want to balance those carrots and sticks so the banking system is actually viable. If you start offering all these things to the non-bank sector and there's no obligation attached to it. All you're doing is encouraging the growth of the non-bank sector with very little oversight or regulation. I mean, I think the big, when people ask me about financial stability issues, I think my biggest concern is the non-bank financial sector, and the reason for it is the lack of transparency into what's happening there. And so I'll give you a very simple example. Archegos. Archegos was a hedge fund that basically made very concentrated bet on single stock names. And as they made bigger and bigger bets, guess what happened? Is they drove up the price of those stocks because there were huge owners of those stocks. And as the stock price went up, they borrowed more money on margin against those stocks, which allowed them to buy more stocks and so on. Well, what happened in the marketplace is that the prime brokers of the major financial firms all thought that they were the number one counterparty of Archegos, and Archegos was actually this big, when in fact Archegos was this big. So it turned out Archegos was much bigger than anyone realized, and so there was a lot more systemic risk in the system than anybody thought. And if we had more transparency and more disclosure, that would never have happened. Archegos never could have, if people had known what they were doing, Archegos wouldn't have been allowed to do it by their counterparties. So a lot more transparency in the non-bank sector would be a good first step.
So let me open up to questions from the audience. Harold?
Thanks. This was terrific. I wanted to follow up on one of your responses to Marcus's question. So you mentioned this curious, what you call a dance between the Treasury Secretary and the Fed chair after the crash. Do you examine in your report the way in which the Fed, either the San Francisco Fed or the system as a whole, dealt with the problem afterwards? In other words, this impression that it gave, some people got the idea that every deposit in the United States is now guaranteed. So that was my first question, kind of follow up to that. When you had a timeout suggestion, what kind of timeout are you thinking about? Because there's a kind of grisly example of that in 2008.
Well,
Ireland did this 2-year thing, and then everybody can see at the end of 2 years it's going to explode.
Well, the other problem with what Ireland did is that Ireland's part of the EU, and
So if Ireland does it and other countries in the European Union don't do it, then the money can flow to Ireland from the other countries. So I remember when Ireland did that, I was like, that they've now destabilized the rest of Europe. I'm searching for a solution to get around this systemic risk assumption because it just isn't ironclad. And you're right that I think people thought that the banks were going to be protected, but they thought it to sort of like a 98% probability, not 100% probability. And I think my own personal view is the cost of running is so low that you really want to make it bulletproof. You really want to make it so people don't run. It's very easy to just move your money somewhere else and see what happens. And then after the smoke clears, move your money back. And you sort of want to avoid that actually happening in the first place. It's an interesting balancing act here. You want to punish the bad actors. So think about it as like the person that's smoking in bed and sets his apartment on fire. But you want to protect the people in the apartment building from that fire and the buildings next to that building from that fire. And so you're trying to figure out a way to balance the supervision and regulation so the person that did the bad behavior gets punished, but the innocent bystander doesn't get hurt. That's tricky. That's tricky to sort out.
So the timeout, how would you set the timeout for 3 days, 1 week, 2 months? Or?
I certainly wouldn't make it 2 years. I think it'd be more to give Congress and the Federal Reserve time to get their act together to decide do they want to do something special on 13.3 lending facilities for the Fed. I mean, the Fed with congressional support and Treasury support can backstop the entire system with the proper support. They can't do it instantaneously, right? So, a week would be enough time to sort of say, we need to do something. And a week would also be a little bit, give people time to sort out like who's really got a problem versus who doesn't. Because the initial response is, I'm going to assume everybody has a problem, and then I'll unassume it as I get more information. So if you have a timeout, you also give a chance for people to sort of validate who actually has a problem, who's actually at risk.
So time also gives you the ability to do a little bit more research, I think. But I don't view it as anything like what Ireland did.
Any other questions otherwise? Yeah, let's talk.
Yeah, thank you so much. Can you comment briefly on what your proposal about banks putting collateral in the discount window could mean for the size and composition of the Fed's balance sheet if there were a run anyway?
It's not on the Fed's balance sheet. All it is collateral that's pledged in case they want to borrow against it in the future. And so the discount window is
very broad in terms of the amount of collateral it accepts. It will accept basically, government securities, mortgage-backed securities, private mortgages, private commercial industrial loans. It'll accept 98%, 97% of a bank balance. It won't accept the bank's buildings as collateral. Won't accept the bank's, computers, technology as collateral. But pretty much, it's very broad. And so what would happen is, so let's say I'm a bank and 50% of my deposits are insured and 50% are uninsured. So I need to come up with sufficient collateral to cover those uninsured deposits. Now remember, I have a lot of collateral because I don't have to have collateral for those insured deposits. So think of, I'm a bank. I have capital, I have insured deposits, and I have uninsured deposits. So I have a lot of collateral relative to the uninsured deposits, as long as uninsured deposits aren't 90% of my liabilities. So most banks are going to have plenty of collateral. They're going to have $2-3 of collateral for every dollar of runnable liabilities. That's why the proposal for most banks isn't very arduous. It's not really that difficult for them to satisfy. There's a few banks that we would need to look at very closely, like the two clearing banks, Bank of New York and State Street, because they have a lot of operational deposits that are uninsured, that are large. So we'd have to think about how do you calibrate it for them. We've also done carve-outs for them for other things, though. They're not subject to the supplemental leverage ratio. So what you want to do is do a detailed quantitative impact study to understand exactly how this affects each type of institution. We just did a very broad brush approach in the paper because that's all we could get help. We got the FDIC research people that were really helpful. They did a run for us. And it showed that most banks wouldn't have much trouble pledging the collateral. And so that was sort of the first cut.
Just have a follow-up.
Show that the program is broadly feasible. So it's worth more investigation.
But don't you try out the private securitized lending market? Because I have parked my collateral already with the Fed. I can't use it to borrow from you, let's say. Typically, traditionally, it was
well, you also get a lot of collateral substitution with the Fed, or also, as long as you can mobilize the collateral, show that that you have enough collateral to move to the Fed in a timely way. I mean, I think there's some interesting questions about how much collateral do you have to pledge against over-the-counter derivatives and things like that. So we sort of have to look at what the total collateral financing needs. But you're only going to answer that question by doing the detailed work. So it's sort of there's a chicken egg problem here. Why should we do the work? We don't have a proposal. Why should we do work? We need the proposal first, and then we do the work to see what the feasibility is and what the constraints are. And that's what we think is the next stage.
Any other? Yes.
I was astonished when SVB went under to read that SVB was not allowed by the San Francisco Fed to hedge the held-to-maturity portfolio because it undermined the very representation of held-to-maturity.
Yeah, there's a funny problem.
So the way that accounting works in the U.S., you can hold your securities in available for sale, or you can hold them into hold-to-maturity. And the advantage of holding in hold-to-maturity is when the value of those securities goes up and down, you don't have to flow it through capital, and you don't have to flow it through your income statement. And there are different standards in terms of the rules applied based on different size classes of banks. So you can see the attraction of putting your securities in the hold-to-maturity portfolio because it makes your capital and your earnings much more stable. The problem is once you have a bunch of these assets in the hold-to-maturity portfolio and they go down in value, one, people see that and they worry about your earnings power because they're going down in value because the securities are not yielding market rates of return anymore. And the second problem is if you try to sell those securities, you then have to remark the whole portfolio. So once they're in there and they're underwater, you don't sell them. And that's what you found in your study. There was no security sales because to sell the securities is essentially crystallize the capital loss. The capital loss is sort of on paper until you actually sell the securities. Once you sell the securities, you crystallize the loss.
Then if you were to take on a hedge position, the hedge position requires some capital requirement, even though it's a hedge. No, is this correct?
It depends on how good the hedge is, yeah.
So if you hold your treasuries, let's say, in a hold-to-maturity account, and you put the interest rate swap on, the interest rate swap needs some capital requirements, even though it's a hedge for your...
Yeah, I'm not even sure how it would work in terms of where would the swap sit and how would the... I don't know the accounting well enough to know exactly whether you could actually balance this. So anyway, so it changes the accounting rules is probably appropriate. I mean, it's a tricky thing figuring out how to handle the hold to maturity versus available for sale because the value of the assets goes up and down, but the value of the liabilities goes up and down too. So stable core deposits are worth more when interest rates are high than when interest rates are low. And so if you sort of say, let's say take the alternative case that we're just going to let all the assets float up and down in value and flow through the capital account, that's probably not really fair to the bank because you're not getting the corresponding offset on the liability side. And figuring out what the appropriate offset on the liability side is too hard to figure out. What's the duration of a deposit? If it's really a sticky deposit, the duration is pretty long. If it's really a not sticky deposit, the duration is very short. So it's almost impossible even to think about what's the duration of deposit. I mean, we saw for Silicon Valley Bank that the duration of deposit was really small, low. But if you look at a clearing bank like Bank of New York, their deposits are really sticky because people need those deposits to actually conduct their business. I remember during the financial crisis, there were two major clearing banks at the time in the U.S., Bank of New York and J.P. Morgan Chase. And J.P. Morgan Chase mostly pulled it back into the business. I remember asking some, well, how quickly could you move your business from Bank of New York to J.P. Morgan? They said, it'd take 3 or 4 months to make that move. So those are sticky. Those are pretty sticky deposits.
Do you think that's worth writing a PhD chapter on that and try to evaluate it, put some numbers on it? Or will it then affect regulation, or is it too complicated to even approach it?
I think it's still in the too hard camp, to figure out what's that duration of the liabilities is, I think, unfortunately.
One is the duration, one is interest rate sensitivity. Do they pay the floating interest rate, or do they have market power? They have pricing power. They're still, like my checking account, still doesn't pay any interest.
Well, that's another consequence of QE. If QE is flooding the banking system with deposits, guess what? You're handing the banks more power to not pay their depositors. I think it's not an accident that the banks are being more reluctant to pay market rates today than I remember during past cycles because of that's a consequence of quantitative easing that nobody really sort of remarks about.
Phil, I wanted to ask about. If I recall correctly, what was going on at the time a year and a half ago, if I was a depositor at J.P. Morgan Chase, I didn't worry. And where I'm going with this is I wonder if the group of 30 have any sensitivity about what's developed since the global financial crisis of the banks too big to fail. And there was a lot of flight of deposits, I believe, a year and a half ago to about 6 banks, particularly gained a lot of deposits because people were insecure with other than the 6 banks that were too big to fail. Does the group of 30 have sensitivities about that experience and how these banks have gotten even bigger and bigger? And then what that means for the banking system and our economy?
So the question is, did the big money
Center banks have the exact same problems as the banks that got in trouble, but the money flowed from the troubled banks to the big money center banks? And the answer, I think, is basically no. The only big money center bank that had a lot of interest rate risk exposure was Bank of America, but they're still, had a lot of capital and they were still making decent earnings, so nobody was very worried about that. So I think the movement from the regionals to the big banks was not so much that they're too big to fail, but that they're fine, that they have enough capital, they have enough liquidity, they're making money. So I guess I don't view it as such a big problem. Remember, the standards for the biggest banks are a lot tougher than they are for the mid-sized banks. So I think that the big banks are, not real. The subsidy that we had prior to the great financial crisis in the banking business, I think has come down a lot. Is there still probably a too big to fail premium? Yeah, but I don't think it's that big at this point. I just don't think it's that big at this point.
Thomas?
I'm interested in your views on sort of the separation or the line between what's the responsibility of Congress versus the agency. So this came up a few times. You mentioned, raising the deposit insurance limit for all banks temporarily. That's something Congress has to do as it did in 2008. That's something the FDIC can decide. And to me, it's sort of striking that after this turmoil from 2023, there isn't really a lot of legislative action that I'm aware of that Congress sort of feels there's something to do. So narrowly, my question is, your particular proposal, is this something Congress would have to write a law on, or is this something the Fed can do?
No, I think the Fed could just do this as a supervisory matter.
I don't think there's any requirement that Congress pass a law. The Fed could just say, from a liquidity management perspective, this is what we want you to do to be safe and sound bank. That's partly why we like it, because it doesn't require legislation, which would be hard to do. Yeah. So,
do you have sort of a wish list? What do you think Congress should do? I mean, we sort of had a lot of action after the great financial crisis, right? The Dodd-Frank Act.
Yeah. So
are we in a good place now, or has this crisis revealed sort of certain things that Congress should address?
I think this crisis was more about bad execution than bad law, right? So banks that got into trouble took crazy risks that they just shouldn't have taken, and you sort of can't legislate, stupidity, right? Making bad choices. So I guess I sort of feel like the core reforms that we got following the great financial crisis: more liquidity, more capital, stress testing. More focus on, central clearing of OTC derivatives, migrating away from LIBOR to SOFR. I mean, there's a whole bunch of things that were done. I think it has made the banking system a lot safer. But it doesn't mean individual banks can't do certain things. And, that's where the supervision comes in. I mean, the Federal Reserve should have caught this. Now, you have to be careful not to blame the supervisor too much. I mean, the bank did it. So you can't sort of say it's the supervisor's fault because they let the children go out and and play with the can of gasoline. It is the bank's fault for what they did, but the Fed could have been much more forceful in stopping, because this is all in plain sight. This is very different than the great financial crisis. The great financial crisis, nobody knew what was really going on. They didn't know how to value the securities. They didn't realize what the fragility was of structured investment vehicles. They didn't realize that CDOs, AAA CDOs were really actually quite risky. There's just all these things that were unknown. This was happening in plain sight. You could see what was happening to these firms' balance sheets. You could see what was happening to their net interest margin. And that's really one reason why I concluded, right after March 2023, that it wasn't probably going to be systemic. I was pretty comfortable that this was not going to be a big problem for the U.S. economy. It made me very, very nervous to say that publicly, because I sort of felt like, you're a former regulator. You can't be optimistic. You have to be pessimistic.
You did say that though.
But I just felt like it wasn't going to turn out to be that big a deal, and it didn't, and it hasn't. Now, are some banks still going to get into difficulty because of their commercial real estate portfolios over the next few years? Absolutely. Will some banks be merged? Will a bank or two fail? Probably, but it probably won't be systemic. When people have transparency into how a bank is doing, then they can discriminate between that bank and other banks. So, I'm a big fan of transparency. I think the more information you get out, the better. So people can, so the bank isn't a black box. I mean, the more it's a black box, the more your incentives are run at the first time of trouble, because you can't assess whether the bank is truly solid or not.
Did you get any pushback from private banks saying, we don't like this proposal? And how does it interact with the Basel endgame? The banks are pushing back a lot at the moment.
Well, we were
pushing back on your proposal.
We were sort of the bank's friends on that, because we said that problems that happened in March 23 were not really about lack of capital, requirements. It was really a liquidity problem and a lender of last resort problem. So we felt like, And especially it wasn't a lack of capital of the money center banks. If you look at the Basel III endgame proposal, the increase in capital for the big banks was much more than the increase in capital for the regional banks. So we felt like the Basel III endgame was, basically orthogonal to the problems that were demonstrated in March of 2023. No, we haven't gotten much pushback. I think banks, are intrigued by, how this would work and would we have enough collateral but we, I think the general view is, yeah, we have a problem here. The liquidity runs can be much faster, and so we need to have a better system to sort of build up, buttress
just to follow
against
up
that.
on Thomas' question, so the Fed board could just decide we do it from next year onwards?
Well, it's not quite that simple. You have to craft a regulatory proposal. You have to go out for comment. You then get those comments, and then you revise the regulatory proposal, and then you actually put it in effect. And the Fed would actually operationally be able to do all these things. So the Fed needs to get its discount window function in working order, so they can actually accept the collateral, manage the collateral, value the collateral quickly and efficiently. So, maybe one reason why the Fed's not moving that fast on this proposal is because they know that they have a lot of work to do in terms of their own, discount window infrastructure, which is usually, because the discount window historically has been used just almost trivially. And so it's never been a big investment focus of the Federal Reserve banks.
Do you have any estimates how much it will cost on the Fed side, on the private bank side, in terms of
I have no idea how much it would cost.
IT investments?
I don't think it would cost that much. I don't think it would cost that much. I mean, I think we're probably talking, billions of dollars as opposed to tens of billions of dollars. I think we know how to do all these things. It's just like automating things and allowing the flow of the collateral to happen much more seamlessly. I don't think it's that expensive.
But somebody has to do the evaluation of all the assets.
Yeah, but they have models for that. So and typically what happens is the assets don't turn. Typically for a lot of banks, the assets don't turn over that fast. So I have a commercial loan. It's a 3-year loan backed by this commercial building, and I submit that to the Fed, and the Fed values it, and there's a haircut against the valuation, and it just sits there at the Fed. I mean, there's no. The collateral of a commercial office building loan has really little value in the market elsewhere. So that will just sit there at the Fed, and it'll just sit there as the collateral, and the Fed will have to value it, every once in a while to be current on its valuation. And they'll use models to do the valuation. So I think it's very, 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 very doable. We did this during the financial crisis at the New York Fed. We had a lot of borrowing at the New York Fed during the financial crisis, especially from some of the foreign banks that came into the New York Fed in size. We managed it pretty easily.
And it would be done centrally at one regional Fed, or there would be 7?
No. Every reserve bank would manage the banks that are domiciled in their district, and you have to have it. So that's why you have to coordinate it across the reserve banks. So it's a lot. It's not like you could snap your fingers and make this so. But my view is, if you've identified a problem, best thing to do is to start to fix the problem rather than assume the problem's just going to fix that itself on its own. So I think they should be going. So they're moving in the right direction. So, whenever you propose something that's fairly radical, you're always waiting for the thump of it to, just dead on arrival. And this is not dead on arrival. So far, so good.
Hi, Mr. Daly. We learned from Professor Brunnemeyer's research that part of the value of the safe assets, like money, is from the benefits of retrading. We call it the surface flow. And I'm interested in your statement that we can make the movement of the collateral in the banking system more efficient to avoid the failure of banks. By doing so, do you think it is possible that we can also, like the value of the collaterals like US Treasuries can also be added because of that benefits?
To the extent that you have a market where you can turn securities into cash easily, that's going to make the whole system work more smoothly. I have a whole separate set of ideas for the Treasury market. I want to make that Treasury security include the ability to turn that Treasury security into cash at the Fed. so that every treasury that's sold actually has the ability to turn into cash without selling the treasuries. So to do repo with the Fed. Mm-hmm. And what this would do is it would mean that people wouldn't have to sell treasuries in times of extremis, because they would know that they could turn into cash whenever they needed the cash. And this would sort of obviate the things like we saw the dash for cash problem at the beginning of the pandemic, where everyone was trying to get out of their treasury, turn their treasuries into cash, and there wasn't enough, the market didn't have the capacity to accommodate that. If you had the ability to do repo with the Fed, you could turn your treasuries into cash pretty simply. This is something Gerald Duffy and I have talked about a bit.
But could you combine the two proposals, or is it it's not so?
The treasury market is pretty, is a small slice of what banks own. So yeah, would this help banks? I think the banks don't really have a problem doing repo against their treasury holdings already. This is really more for other treasury holders who are thinking about, okay, I'm worried that the treasury market is becoming dysfunctional. So should I sell my treasuries today just in case I need the cash tomorrow? Oh, it'd be much easier if I could just take the treasury to the Fed and borrow against it.
Okay.
The Federal Reserve is the only entity that has a completely elastic balance sheet. So the value of the Fed is that in times of crisis where there's an increase in demand for liquidity, the Federal Reserve or a central bank anywhere is the only entity that can actually do that. And so we need to put in place more mechanisms that allow that to happen seamlessly, that are known ex ante. What we tend to do is we wait for something bad to happen, and then the central bank says, oh, we're going to offer this new facility that will allow us to expand our balance sheet. But doing it ex ante rather than ex post could actually reduce the chance of the crisis in the first place. So that's where my bias is.
So let me conclude with a final question. All these facilities they're all standing facilities, no? Can't we just revive them, or they're still around? So like in March 2020, when suddenly you could just bring treasuries to the Fed, this facility is still around, or is?
Oh, the Fed. So there's two sets of kind of facilities. So there's facilities that the Fed can offer without any active Congress cooperation from the U.S. Treasury. They're basically for treasuries, agency mortgage-backed securities, and agency debt. That's it. That's Section 10B. They can do a lot. They can lend against those things all night long. Anything else? Section 13.3. Special lending requires an act of authority of Congress and the Treasury Congress has to essentially authorize the money. Treasury has to basically agree to it. And then the Fed basically has equity capital to sort of support that lending. Much more difficult to get to lending for anything else. So it's that's why when we had the crisis, the Fed came forward with a bond facility where they would lend against treasuries and agency MBS at par value, even for assets that were trading at 75, 80 cents on the dollar. They had the authority to do that without any congressional action. But their authority to move unilaterally is pretty limited.
So I would like to thank you.
As it should be.
I would like to thank you for laying out the proposal in all details, and hopefully we wish you a lot of success to implement it, and hopefully it will become reality very soon. And thanks to all of you.
I'm sure hoping 5 years.